everybody. I'm here in Keith's office here at Wintrust. Say hello,
Welcome.
Keith.
Hello.
Yes. Anyway, I wanted to recap while we're waiting for some of our friends to join us online here. The first two videos were basically about general consumer information. And the first one was about buying power and what happens to your buying power as the interest rates go up. And the second one was about the myths that people have before they buy a property. And Keith deals with this all the time, and I wanted you guys to hear it straight from the source. And Keith is the one that really slays those myths for us. So a lot of times people think they need outstanding credit or they need to have huge amounts of money down. And again, we're here with Keith so he can explain to you some of the things that make people successful in purchasing a house. And I am going to tell a couple stories on Keith right now, Keith. One of them is a good friend of ours and a long-term client, Frankie, and his wife, Malia, ended up buying their dream home in Sand Canyon because they had followed some good advice that I had given them years ago, and they talked to Keith. They were ready for 2 years before they pulled the trigger on this purchase. And the reason they were able to get the deal is because they did all their homework. And this was a buy-up property, and they were able to keep their house as a rental because they did some strategizing with Keith way in advance. The other thing I wanted to point out is how fortunate a couple of our clients have been that have, again, taken our advice, come talk to you well before they got started the home buying process. And I think we won't mention names out here, but a couple of our clients had won the bids in multiple offers because the other agent trusted the transaction would close because the buyer was working with you. Excellent. And liked our team and the other components of the offer. Wonderful. So it really pays for these people to get informed. So Keith, take it away. Inform our people.
Thank you for having me. Absolutely. Well, I share with folks because oftentimes folks, when we first get into a conversation, feel that there's a lot involved in home financing. In some ways, sure, there is. But in terms of the consumer, what I like to share, there's really three key pieces to the puzzle. There's the down payment, and there's a lot of wonderful down payment options and minimum down payment options with a conventional loan as little as 3% down, FHA 3.5% down, and with down payment and closing cost assistance programs in the market, there might be some opportunity to lower that overall out-of-pocket expense. And a lot of that's case by case, and happy to chat with anyone and go over what someone has going on and see what opportunities and options are out there. But oftentimes there's more flexibility when it comes to the amount out of pocket that our buyers originally anticipate and think. The second piece of the puzzle is qualifying income. And a lot of folks, and I hear it quite often, they hear or have heard stories that it's real difficult to obtain a home mortgage, but more times than not, going through someone's qualification and loan options and looking at their qualifying income, and we go off of gross income, not net income, and oftentimes folks are surprised as to how much they qualify for, and oh really, you'll actually give me that amount of money? And that's where I come back and share with folks, just because we can provide it doesn't mean you should take it. You need to have your own budget and know what's comfortable for you and your family and overall life goals, but a lot of great opportunities there. And then credit. So the third piece of the puzzle is credit. Credit's the one area that I really emphasize on, because credit's typically the one area that we may be able to provide some additional guidance and some communication to our customers, especially early on in the process. So I actually put up a couple of credit tips that I think if, really, whether you're 2 years out or you're looking to purchase next week, these would be good sound pieces of advice to take and to check into if you haven't yet already done so. And my first one here is to have 3 open and active credit accounts, and 2 out of those 3 credit accounts to be credit cards. So the credit bureau's scoring model, ideally they want to see that you have open and active credit and that you're not really so much needing it, and that certainly you're not abusing it. So obviously making sure your payments are made on time, but showing that you have a few open and active accounts that you're using, that you're paying on time, that you're able to pay down those balances, that you're not getting yourself into, say, too much debt or over leveraging. That really helps drive a credit score.
Got it. So don't max out the Target card.
Yes.
And leave the other 2. Okay.
Yes, exactly. And that's kind of
don't max out Target cards.
You're jumping ahead to my tip number 2 here, because so keep credit card balances down. at or below 30% of their available limit. So if the limit is $1,000, try not to owe more than $300, 30% of that available limit. And don't max out one card. I see this as a common mistake. Well, folks will have, say, 2 or 3 credit cards, but they only use one. Maybe they have a lower APR, they get more points on that card, so they'll max out the one. We'll put that one card, that ratio, over 30%, and that will lower their credit score. So it may be best to spread it out over 2 or 3 cards, keep all 2 or 3 accounts below the 30%. That will help maximize the score.
So maxing out a card could actually lower somebody's credit score.
Yes.
That's
absolutely, absolutely.
And that's a big one, and that's part of the why we want you to come and talk to a professional like Keith way before the stress of being in a transaction.
To 600, other loan options down to 620, and in general, the higher the credit score, typically the lower cost of funds, or there might be some additional options for lower cost, or maybe some different loan programs available.
So lower cost meaning it's a better interest rate, or the cost of the loan itself?
I would say interest rate, yes.
Yeah, okay,
or say
good.
Someone that has really great credit, maybe not so, maybe compared to someone that doesn't have the greatest credit. For that person that doesn't have the greatest credit to obtain the same interest rate, they would have to pay some extra fees and points to take that same interest rate, or they may see a little higher interest rate to avoid paying those extra fees and points.
Okay,
yeah.
Good to know.
So when it comes to credit, if we look at like what makes up your credit score on a chart, 35% is your payment history, and then 30%, so that balance versus limit ratio, almost equally as important, has to do with this right here, owing less than 30% of that available limit. And then the other thing I'll share is kind of my third tip. If you have open and active collections, to look at addressing them. Oftentimes I'll hear people say, well, once it's been there for 7 years, it's going to fall off and not be an issue any longer. We have seen, and oftentimes we'll see a collection company, if they're not being able to collect from you, will sell the debt to another collection company. That new collection company will come and re-report and reattach themselves as a collection, and then that time frame starts all over again. So best to get those addressed. And if you have questions on any of the above, particularly collections, what you should, what tips you as an individual, may want to look out for in terms of bringing up your individual credit score, because each situation, can be unique and pertaining to, what you individually have going on. Happy to answer any questions and would certainly love to help with that.
That's awesome. And then you also were going to go over like the cost of money, weren't you?
Yeah, let's see here. So we have what we call our food for thought, and something I commonly share with my buyers. And one thing I'll share here is an average of on average, a $10,000 difference in price will adjust the monthly payment by $50 to $60 a month. So if the house today costs $500,000 compared to a house maybe a month from now costing $510,000, that payment difference would be $50 to $60 a month on average. And then also share on average, a 1% difference in rate will impact buying power by 10%.
Wow.
So it sounds like a big number, but kind of what does that mean? And putting a little bit of perspective, wanted to give everyone an example. So the example that we put forth here is if we have a $600,000 purchase price, and let's say over the next year or so, home prices increase by 5%. Historically, that's been the average rate of appreciation throughout Los Angeles County, right about 5%. That means that home would then be $630,000. And if the APR or interest rates are, say, at the time in the mid-4s, say 4.625, and now interest rates go up 0.5% to where they're at 5.125, the payment difference on that would be about $300 a month. If we take that over 5 years, $18,000. If we take that $300 difference over 30 years, $108,000.
Wow.
It can add up quick.
It can add up really quick. Well, I hope you appreciated learning a little more about what you can do to take some control over improving your credit score, and you see the value of talking to a professional lender like Keith well before you're ready to start your home buying process, because this can take so much heartburn out of the process for you and actually make it pleasurable and put you back in the driver's seat. Thanks for tuning in with us, and we'll talk to you next Tuesday when we have some more fun information.
Thank you.